So I'm a co-founder here at Vega, and I'm here today with Dave Hrycyszyn, who's our lead blockchain engineer. We're going to talk to you about Vega, which is a project to bring the benefits of the blockchain to financial products, starting with derivatives. We're going to start with a brief primer on derivatives, why they're interesting and useful, and why we should care about them, bringing them onto the blockchain. Derivatives and other products are actually quite special in that we can bring them entirely onto blockchain-based systems rather than needing to sort of interact in some ways with, I guess, the real world. But doing so does present some new challenges and some things which maybe aren't suited to the traditional blockchains we've seen so far. So we'll dig into some of that, and then we'll dive into the Vega Protocol. We'll look at our answer to these challenges. I'll take you through some of the concepts and key features of our design, and Dave will do a bit more of a deep dive on some of the technology decisions and why we made them. So next slide. So starting off, sort of primer on derivatives. Derivatives are financial products, and in the traditional markets, they're usually represented as a contract between two banks, or a bank and a trader, a bank and a fund, etc. These contracts effectively specify how much money and when and under what conditions should be paid from one to the other. And there are a huge number of different types of derivative contracts. For instance, an option, which gives you the right but not the obligation to buy something. So you can get an option to buy Vodafone shares at 500 in 6 months' time, and if Vodafone shares turn out to be worth 700, then you can execute that option and you make a nice profit. If they don't, you can just ignore it. Another example is the future or forward contract. Those contracts mean that you can actually agree a price now to buy or sell something in the future. And that can be a very useful thing if you are a farmer, or if you have a delivery of some stock or product, or even some currency from operations abroad. You can agree a price and get it locked in for the future, and you can have less risk and a more predictable business. So there's some real use cases. Another thing to note is that derivatives are generally traded on margin, and what that means is that rather than putting up all of the money that you might win or lose to enter into a derivative contract, what you can do is you can actually put up an amount which covers the biggest loss or gain that might be expected in a reasonable amount of time. And then if the trade moves against you, you might have to put up more margin, but if it doesn't, then you'll continue with that margin as is. And that means that the amount of money you have to put up to enter a derivative contract, even with a very large notional size, can actually be much smaller. There's a quote there from Warren Buffett. Derivatives are financial weapons of mass destruction, he said in 2002, which was about 5 years before they did cause a fair amount of destruction. So what's going on here? Are they really all that bad? Well, not really. The products themselves are fairly innocuous, but if they're used recklessly, they can be. And what do I mean by recklessly? Well, what I mean is, if you can sign a contract, you put up $1 million or $10 million, and you can sign a contract which, when it comes to an end, might mean you owe $100 million. And if you then do that tens of thousands of times with a bunch of banks in an interconnected web with no transparency and no real view of how much you might owe in those situations, then sure, when it all goes wrong and you turn to owe 10 times what you actually put up, and you owe that to 10 different people, things are going to get hairy. But that's not necessarily a problem with the products. That's a problem with the way that they were traded, with the transparency, and with what these institutions were allowed to sort of sign themselves up for. So what are the real use cases of derivatives? Why would you as a business or as an individual be interested in these products? Well, there are four main areas. The first one is insurance. Derivatives can actually be used as a way to insure against events. They're not like your normal house insurance, because that's a really bespoke thing that's tied to your specific house and its risk. But say you have an exposure to another company and you are interested in insuring against the company going bankrupt. Let's say you sell a lot of things to Maplin, and when Maplin went bankrupt, that was a bad problem for you. So what you could do is you could insure that risk by taking out a credit default swap, which is a kind of derivative that pays out if a company defaults. So that's an example of the way that a derivative contract based on another type of financial instrument, the shares of a company, can actually be used in order to insure against certain types of risk. Hedging is another option. Hedging is similar to insurance, but it's more about dealing with everyday risks and uncertainties. So if you receive euros from your overseas operations, and you receive them every month, maybe 100,000 euros a month, but actually what you really need is to know how many pounds you're going to be getting in order to manage your business in the UK. what you can do is you can enter into a derivative contract to sell those euros for pounds at a pre-agreed price, giving you stability for your business and making it easier to make decisions that affect your future. Again, hedging's a huge use of derivatives, one of the largest uses, and it gets used for the price of asset hedging, hedging against volatility or large moves in the market, hedging against exposures to other companies, and hedging for currency risk. Obviously, speculation. This is the one that we all know and love. Any fund managers here or anyone who has tried day trading will know that there are many different views you can take on the market, and you can go long. You can buy your favorite coin from a crypto point of view. You can buy your favorite shares, but if you think that maybe a certain coin or a certain share is bad news, it's difficult to sell it short. And derivatives give you an answer. They allow you to actually agree to sell as a derivative product and to make a profit if the thing goes down. Or they allow you to take a view on the future volatility. If you think that Bitcoin volatility will settle down in the future, you can use options to say, yeah, I'm going to make a trade that will pay off if the volatility of Bitcoin reduces. And finally, I guess gambling, and betting. And what that means is actually, you can have a derivative which is based on an event, like the outcome of a sports game or the outcome of an election. And there are some betting platforms like Betfair which are very, very close to effectively trading systems when you actually use them. And effectively what that's showing is that derivative products structured in the right way can also act as gambling products and betting products and give you access to those sorts of markets. And there's a huge wide range of things that derivatives can be used for in the market. They are of interest to all of us and all of our companies and all of our work, even if we don't necessarily realize it. Most companies will have some commercial banking exposure to something that looks like a derivative if they're of a reasonable size. And to summarize, so derivatives, there's a broad category of products that cover derivatives. It's not always all that obvious what is a derivative. Something that actually looks like a fairly consumer-oriented product could actually underneath be backed up by a derivative trade, which is actually how they offer that product to you. It is a type of product that can be used to efficiently allocate and spread risk about. And that's the key thing about derivatives, is they let you sort of unbundle some of the aspects of your liabilities. And actually, if you're interested in a certain type of risk, you can take on more of it and you can gain the benefit. Or if you're actually uninterested in having that risk, and if actually it's bad for your business and it makes things uncertain, then you can sell that risk off to someone who wants it. They play a crucial function in the markets. So why do we care? Why do we care about this? Let's think about why Bitcoin and other cryptocurrencies were brought into existence. The existence of the sort of crypto space generally exists around the idea of decentralization, of making things peer-to-peer, of removing centralized government control, making sure that everyone can access things, and making sure that there aren't special tiers where companies and governments have the ability to stop people accessing certain products, or the ability to charge a special fee to access a certain market. That's why Bitcoin and the cryptocurrencies exist. And what you'll find when you look at the financial system is if you actually want to do that for our financial system, and if you want to do that for the way the world works and does business, you need to cover more than just money. You actually need to look at the financial products that are built on top of the money and say, how do we decentralize these products? How do we make sure that the farmer in Africa who is underbanked and has no access to banking services, we give them access to Bitcoin? Sure, great, they can go and trade some crazy volatile currency, but hopefully in future less volatile. They can get their electronic money, but they're still shut out of all these services which are useful to them. They're still at a disadvantage. And so the reason we should care about bringing these sorts of products and other financial products onto an entirely decentralized world is so that the same benefits can be extended to all of these types of products that are needed to create the modern economy, to keep it stable and to keep it running. So the challenge, why is this hard? This is something that is a little bit tougher than just building Bitcoin for a number of reasons. There's a few technical challenges. Firstly, when you're sending money like Bitcoin, it's a fairly static transaction. You know how much you're sending, you know where, and it simply fails or succeeds. When you're trading a financial product, it actually has a lifetime. You have to determine the price of that product. You also have to execute the product through its lifetime, and then at the end of the product's maturity, which could be months in the future, you need to settle that product and you need to settle up the liabilities between people. Now that's a lot more of a big ask than simply running one atomic transaction in a block, committing it to a blockchain, and off you go. The first thing is you need a good distributed exchange if you want to do decentralized derivatives, because if you decentralize the product, but then make people go via centralized hoops to find the price and to trade it, well, you're not really decentralizing it because no one actually has access. So we need order books, we need prices, we need trading, and we need this to happen in a reasonably performant way. Performance matters a lot when it comes to trading, particularly for derivatives. We need to do margin calculations, we need to calculate settlement, and the kind of calculations in these things, they're not supercomputer calculations, but you give them to an Ethereum smart contract, and the gas you're paying is probably going to be more than you have in your Ethereum wallet. So I wouldn't recommend it. So we need to do those things, and we need to scale it. We need to scale it so that when we say to the world, come and create the derivatives markets that you want, come and build the futures in the products that you have liabilities in, build the options that you need, build the betting products that you want to see gamble with your customers. When we say that to the world, and when we open this up in the way that Bitcoin is open to everyone in a permissionless way, we need this to be able to scale to that many markets, not 25 transactions per second across the entire blockchain, but multiple transactions a second across a number of markets. And so we sat down and we looked at it, and everyone else who is trying derivatives in the blockchain space is either cheating or they're avoiding it entirely. And what I mean by cheating is, they've built a nice on-chain settlement smart contract, but they haven't dealt with the trading side, so they've actually got a centralized exchange and they're just using the blockchain for settlement. Or they're avoiding it because they've designed a protocol which is lovely and allows you to trade the things, but leaves it up to you how you determine the price. Now, in our view, these things all need to go hand in hand. To bring these products onto the blockchain, to do it in a way that will be useful to everyone who's trading, whether they're trading crypto today or whether they're trading other non-crypto products in future. To do that, we really need to cover all of the things we just talked about. We need to get the exchange and price determination. We need to get the performance. We need to bring it all into a decentralized place where it can be end-to-end executed. And that is what Vega's trying to do. So the other thing that matters, and is a big challenge, is liquidity. A market with no prices and no liquidity is not really a market. It's not very useful. So I don't know if anyone here has tried to use EtherDelta or even looked at EtherDelta. They have, I don't know, say 1,500 markets, but each of those 1,500 markets has very little going on. And if you really have to buy or sell something and you have no other way to get that crypto asset, sure, maybe EtherDelta is where you're going to end up, but these kind of platforms are not compelling. You're not going to build a big marketplace there, and as a result, because of the latency problem, because of the speed, and because of the lack of incentive to create liquidity, the trading is all elsewhere. And platforms like EtherDelta actually are sort of a wasteland in many of their order books. And the marketplace needs the prices. You need prices to do things like margining. If you want to know how much margin to take off of each of your participants, you need to know what the current price of that instrument is. So we really need a well-priced liquid marketplace. And traditionally, in a centralized exchange, that's a company who have an incentive to do that. They come along, they spend money advertising, they only open markets that they know will have liquidity, and they put their effort into bringing the liquidity on board. If we want to do this in a permissionless way, if we want to open this to everyone, we need a solution that scales and a solution that incentivizes liquidity without closing down the platform and giving some central control. So, introducing Vega. Vega is an end-to-end, fully decentralized derivatives marketplace. Vega includes a high-performance distributed exchange. It includes safe margined trading. It includes settlement across blockchains, so starting with Ethereum and ERC20 tokens, we'll eventually be able to settle assets across multiple blockchains. It includes a concept of smart products, which our quant team, David Siska up in Edinburgh, as an ex-BNP Paribas quant, has been working very hard to work out how we model and calculate the risk and margin on an arbitrarily complex set of derivative products which we won't know in advance. And it includes a market-making model that incentivizes market making and ensures liquidity on all the markets on Vega. And this is absolutely crucial. So remember Warren Buffett. The issue that caused the financial weapons of mass destruction is partly a lack of transparency. No one really knew what anyone else was doing. But it's also mostly, as I mentioned before, the prospect of unbounded losses, the prospect of being able to sign a contract in the morning, give me $100, and come back tomorrow morning and owe me $2,000. And that's a real problem, and it's a really unsafe thing to do, particularly if you're opening up a platform to anyone on Earth. So Vega is different. Vega, you can't lose more than you pay in. And David, our quant, has been working hard to model this and to model what is the prospect of loss, how much might you lose, and how do we safely close a trade before you are going to owe more than you've put in. We've got some really good numbers on this already. We've got this working for forwards and option contracts, and David is now working on a research paper to extend this to arbitrarily complex derivatives using deep learning. That research paper should be out in the next couple of months, and that will sort of guide our future development from the first set of products through to more complex derivatives. So smart products, what's a smart product? It's a specific type of smart contract. So rather than the kind of Ethereum smart contract, which can do absolutely anything, but very, very slowly, smart products are a very small, narrow subset of contracts which allow you to specify financial products and instruments with a great level of clarity and precision, but also in a way that allows our network and our software to calculate the margin and to do things like map them back to real-world financial contracts if necessary. It does this by allowing you to combine financial primitives, so the concepts like optionality, or the concept of receiving money or an asset on a date, or the concept of a conditional barrier of if this, then that. It can combine those concepts in any arbitrarily complex way and with any set of underlying assets and produce a contract that represents the risk or the opportunity that you want to get trading access to. So finally, how do we solve the liquidity problem? So within Vega, we solve the liquidity problem by having a concept of market maker staking. So although anyone can create a market on Vega to trade derivatives for effectively any underlying product they want, the market will only be brought into existence if that trade and if that proposal is backed up by one or more market makers who are willing to commit to providing prices. Market makers come in, they place a stake into the Vega smart contract, and they commit to providing prices. When that commitment is made, Vega will bring the market into existence, and it will use that stake to penalize market makers who don't provide prices. So that way we have market makers committed to always providing round-the-clock liquidity on the markets, and as a thank you for doing so, as a reward for putting that stake up and for making that commitment, market makers will receive a share of the fees on the Vega platform. In fact, like with Bitcoin, Ethereum, and others, Vega, the team, are not taking any fees from trading. So trading happens feelessly from our perspective, and the fees all go between participants. So all of the fees on the platform exist to make sure that we encourage liquidity and we encourage trading and create the most vibrant marketplace that we can. So now I'm going to hand over to Dave to take you under the hood of Vega and talk a little bit about how the blockchain technology works.
Cool. So I'm in charge of making the thing work from both kind of scalability and speed perspective. Speed is one of the most important things to traders. They like volume. They like to scream sell really often, buy really often, and so. Starting the project, it was pretty clear that this was going to be one of the hardest things I've probably ever done. Trading systems are pretty well understood by now. There are centralized ones, people know how to make them, but I don't think it's well understood how to build something like this, so we're still feeling our way forward to some extent. When we started, we said, okay, existing proof-of-work blockchains, the two components of speed that we are concerned with when it comes to those are latency. That is, how long does it take for something that we can depend on to happen? So you do a Bitcoin transfer, and yeah, people say the block time is 10 minutes, but it's actually, then they say wait 6 blocks unless you're buying a cup of coffee, and then then they say if you're doing something high value, wait 13 blocks, and then you have a 1 in a million chance of a block reversion. So it's a bad finality property in Bitcoin. And it's, broadly speaking, the same in Ethereum. The block time is faster, but there's more forks. So when it comes to trading, if that's your technical platform, you're going to be in pretty slow, you're going to be in the slow lane, let's say. You're going to have very, very high finality latency, finality being the property of can you depend on something that is in your chain. The second thing that we worry about is throughput. And throughput is usually measured in transactions per second. And again, the story for the big two is not super great. 25 transactions per second for the whole world for Ethereum, and 7 transactions per second for Bitcoin, roughly. And so we can see that those probably wouldn't do the job for what Barney was asking to do. A related problem is high processing costs in Ethereum. So if you only have 25 transactions per second for the world, those are very, very expensive transactions, and you need to guard them quite closely, and you have to charge lots of money for people who want to use them. So the gas prices would be very high if you attempted to, I don't know, build a dynamic margining calculation that said the price of something moving forward is X right now, and then update that, well, you couldn't really update it multiple times per second, but you would want to, so that's a big problem. Also, the kinds of libraries that would be necessary to build a lot of this stuff, neural networks or other machine learning components, they don't exist in that ecosystem either. So it was pretty clear that there's just too many problems. We weren't going to be able to build using the older systems. So we do have the capability to roll our own consensus system. We rejected that, but I'm involved in a different project called Chainspace that perhaps I'll come back and chat about sometime, where we are actually doing that, but we don't want to do that for this because we've got other stuff to think about. So when we started out, we had this hilarious conversation. This was very, very funny to me. It probably wasn't very funny to Barney. I said, so how fast is fast in your world, Barney? Like, you're a trader, so like, what does fast mean to you? And he's like, he does this kind of calculation in his head, a little bit of bullshit. He goes like, oh yeah, well, a normal trading system is about 4 milliseconds, so 4 thousandths of a second per trade. So I'll give him some slack. Well, maybe 100 milliseconds is what he said. So does anybody see the problem in a globally distributed consensus system with 100 millisecond time? Can anybody?
No, it's fine.
Out there? You chuck it. What do you think?
I think the give it 5 bytes
Right. Okay. So the speed of light means that in fiber, Australia is 300 milliseconds away from us right now. So it's triple what Barney's original sort of desired speed was. So it was actually the shortest and perhaps most pleasurable programmer conversation I've ever had, because a lot of the time people ask you for something and they say like, yeah, but yeah, I know it's hard, but you could do it, right? And I could just kind of, this is a single case where I was able to like invoke a universal constant that said, no, what you're asking me for is completely impossible, and we're going to have to come up with a different answer for that one. So it was a deeply satisfying moment in my programming career. Basically where we went, though, was we did some research about what is the fastest possible consensus time that we can get, and not just consensus on the initial thing of what happened, but also finality consensus, because that's what we really care about. We don't care so much about maybe something will happen in the future. What we care about is that we can prove that it happened now, because a trader needs to be constantly updating their positions based on information that is actually real. And if people are feeding transactions into the system, some of them from Australia, some of them from London, some of them from Singapore, some of them from Berlin or New York, and all seeing each other's transactions, they need to have an order that they can depend on pretty rapidly. And I'll whip up an architecture diagram a little bit later to discuss it. Anyways, what we settled on was a system called Tendermint. Has anyone ever heard of that? So yeah, cool. So we decided to go with Tendermint primarily because it could probably give us the best latency story and quite a decent throughput story as well. So I guess the general characteristics of a Tendermint app are you write your application in pretty much whatever language you want, and you listen on a socket, and you basically conform to a kind of back and forth dance that the application requires of you, or you write your application in Go, and you conform to an interface, and you basically get the, there we go, cool. Yeah, this is our awesome technical diagram. Yeah, and you conform to an interface and basically compile the whole thing together, and it runs like that. The nodes on this diagram, think of them as, they're basically Tendermint validators. We have a prototype, which I'll show you in a few minutes, which is basically running on, we're running 3 Tendermint validator nodes. One of them, assume the one on the left is in London, that one. The one in the middle is in Dallas, because I'm a fan of that television show. And the one on the right is in Singapore. So that's what we did to prove the kind of consensus properties of Tendermint workplaces. So what we found was we were able to get agreement when we feed a transaction into, say, the node on the left, the London node. So let's say you'd said, hey, I would like to put in an order to buy Bitcoin at $9,000, and I want to buy 50 of those. That's your move. That transaction is then, okay, cool. So we got a transaction coming in from the left. That node, on the London node, will send it to both of the other 2 nodes. They'll gossip back and forth. There's a 4-round dance that they do together. So keep in mind, the speed of light is constraining us, but you get about, say, you get about a block a second, and you get a latency of about between 1.5 and 2.5 seconds of time. And they do the dance, and once they've all done it, they can say, okay, this transaction has come in, this order has come in, and it will go, each of us know the order that it's in, and we will deliver these transactions here, these orders that are coming in, to the trading application that Barney has built a prototype of. So basically what we did by starting out to do was we can distribute transactions around the world. It takes about 2.5 seconds, and we're seeing performance of between 500 and 1,000 transactions per second pretty consistently. And that's basically the way the system works. The whole thing is compiled as one binary. It's written in Go, and each one then executes the list of transactions that it gets in the same order, and the trading app runs the code. So that's a basic overview of what we built. I guess, yeah, we also show a picture of what the
next one?
UI looks like. Yeah.
Yep.
We solved the Australia problem, 300 milliseconds.
Yeah, so there's a 4-hop dance that they do, and we set the block time at 1 second, thinking, all right, well, if we can have a block a second, which is fine, but we basically end up having a latency that's longer than the block time, because you may get it while you may send it into the system while one block is being produced, and that may go in 1 or 2 blocks later, basically, depending on where they are on these nodes doing the dance together. So yeah.
How many transactions in the block, more or less?
It depends on what you're hitting it with, but I guess, I mean, if you're doing 1,000 a second, you're probably going to have, on average, 1,000 transactions in your block. So, yeah. So here's the trading interface. Do you want to talk about what a trade is, Barney?
Yeah, sure. As we talked about earlier, one of the things that we need to do to create a marketplace for derivatives that's fully decentralized is have a way of determining the price of these things. And as probably most people here are aware, a common way of doing this, at least for regularly traded things, is through an exchange. So what we've effectively built as part of this application is a decentralized exchange. And what that does is it takes a lot of buy orders and a lot of sell orders, where buy orders are people saying, hey, I'm willing to buy 100 of these and I'm willing to pay up to £50 or 50 Ethereum. I'm willing to buy 200 of these and I'm willing to pay 60 Ethereum, etc. And it sorts them in order of price and then in order of when they came in. And the same for the sell orders. So you just maintain 2 big long lists sorted by price then time. And every time those lists overlap, that means that you've got some orders that can make a trade. It means you've got some people who actually have something that they can do a deal on. So if Dave has entered an order to buy 50 for up to 100, and I come in and say, hey, well, I want to sell 40, and I'm willing to sell for as low as 90, then that's going to cross over and it hits the book, and the trading engine is going to say, hey, I can see a trade there, I can sell 40 to Dave. It's going to execute that trade, and that's what you see here. So what you see a list of orders coming in on the left-hand side, and then you see a list of trades matching as the orders match against those trades. And I think this is just a GIF repeating the entry of one order. So all you're really seeing is one order coming in, getting added, and that matching against a bunch of orders that are already on the book and creating a number of trades. So, if you've got someone was selling at 20, someone selling at 50, someone else selling at 50, and you come in buying for up to 50, then you may end up hitting more than one order and creating multiple trades with those people. And that's what we're showing here. And that's the first part and one of the sort of core component that kicks everything off in Vega. Because every time a trade is made, that's actually what sets the price. So when you look at a ticker on the web and you see the price of Bitcoin is $10,000 or $19,000 or $6,000, presumably all in the same 5-minute period, when you see that, what you're actually seeing is the last price that Bitcoin traded at on a given exchange or a number of exchanges. And so one of the things that we do is every time that price changes, we go and take a look at all of the trades we've got, and we reevaluate them based on this new price. We say, okay, well, I have a trade with Dave for 50, and I'm long and he's short, so price has changed, it's gone up by 5%. What does that mean? We reevaluate that trade, and we decide whether one or other of the people doesn't have enough money in their account for the risk that they have in that trade, for how much they're going to owe the network. And if they don't have enough money in their account, then we'll close the trade. If they're close, we'll probably send them a notification saying, hey, you want to watch this? If it goes down another X, your trade's going to be closed. So we do that every single time the price changes. We'll reevaluate the whole state of the order book and close anything that needs closing.
So this is a simulation of shooting a lot of transactions at the system. Probably the key thing is that number up there that I highlighted in red during when I recorded this earlier. You can see it bursting. The performance app that we're hitting it with will burst from four transactions per second up to about 1,000 or so. But sometimes there's a write-ahead log, so that sometimes it's processing more than the maximum. And you can see it, the block right over there, it's basically producing 1 or 2 logs a second, basically, at almost all times. So that's the thing. It's hard to see them, but there is on the screen, but there is actually a map here. You can see which nodes are active, and this, if a node dies for some reason, then say the London node died, then you'll be able to see it turn red on there as well. So yeah, we're also getting the metrics and all the information systems going so that people will have good information at their fingertips to use the system with.
So this is the Vega roadmap. We started the company in sort of January of this year, and probably the last 6 to 8 weeks have really ramped up the team and ramped up the development work. So what you've been seeing here is a very, very early snapshot, sort of proof of concept, proving that all of the little bit moving parts and all of the key problems have been solved, but we are a little way off from having something that does real trading with real money. However, we're looking to have an alpha live on probably the Ethereum mainnet and obviously our own network deployed for the trading around August. That will have some training wheels on, so we'll have some more control than we will have in the final system to make sure that if anything goes wrong, we don't have the DAO type situation where someone runs off with everyone's money and we have to close as a company. So we will be a little bit more cautious than that, the alpha period. And then sort of around December time, end of this year, beginning of next, we'll move into a beta. We'll start to open up the market making and the running of nodes to more participants. We'll start to realize more of our vision around the permissionless creation of markets. And I'll really start to kick the network into gear and start the sort of growth trajectory. And then through 2019 and probably on into 2020, we'll be rolling out some of the more complex features around the smart products and some of the other ambitions we have for the product. So really, really early days yet. You guys have had a sneak preview of something that just about works, but is really a proof of concept. Well, the answer is partly that we're still in the process of taking some advice on some aspects of it, and so our final structure isn't 100% confirmed. But a couple of things I can say is that because this is a permissionless, decentralized network, we are aiming not to be held responsible for running a trading venue for derivatives. We're writing the software, we're putting it out there to a collection of nodes to run it, and it won't be our system, it'll be a decentralized system. So that's one side of it. The other side of it obviously is the trading and the market making activities that will go on, and for every participant who wants to trade on Vega, they will need to make sure they understand the laws in their local jurisdiction, whether they are allowed to do so and any restrictions that might apply. So we're not. So we're planning to make the platform open for anyone to run, but we won't Well, we do actually plan to be one of the first market makers and originators on the platform, but not in the same sort of legal entity that's building it. The reason we're doing that is because we want to make sure that we open some liquid and useful markets. But the general goal for Vega in the long term is not to be trading ourselves, but to be creating the technology that connects any group of people who want to trade. There's a possibility that we may sell other versions of the technology to banks to use sort of in groups of banks, but the general goal is to open up the trading and the access to these instruments and to these kinds of products in the same way that the Bitcoin opens up access to digital money. So firstly, are we adding fuel to the fire? It's an interesting question, partly because we're not focused on purely cryptocurrency derivatives, although that will be where we launch for the variety of reasons, partly because the people who are most comfortable with the sort of blockchain space will be people trading cryptocurrencies, so it's the easiest launch area. But we do look to create markets in derivatives across many spaces. We mentioned things like sports betting, things like contract for difference in equities, traditional derivative markets in the future. So there's a lot of different markets we're looking at. It's possible also that actually having the ability to go short, for instance, on some of these coins will have the opposite effect of fueling the fire and will actually allow a dampening effect to come in as people are able to short some of the things that are jumping up too much. So I think having a more mature market with more options for trading is probably good. But as with anything, there are always risks as well. As for 0x, 0x is a protocol for effectively the exchange of assets. So it's more like it's an exchange protocol. It's not a derivative settlement protocol. There's actually DYDX is a protocol built on top of 0x for executing derivative trades, but it doesn't work in quite the same way as what we're doing. And even 0x and DYDX together don't provide the end-to-end settlement and the end-to-end marketplace that we're trying to build. And we've looked at things like DYDX, and actually what they're doing is they're one of the ones that are sort of cheating and going back to a centralized marketplace. And if a centralized marketplace works for you, it's possible that they will be successful. But actually, what we're looking to do is decentralize the sort of entire activity. Yes, so we're currently still working through, and we're actually running a set of roundtables with traders and funds and other people who have run market-making activities in order to sort of calibrate the governance. But there will be the requirements to provide prices will involve requirements around the size of the price that you have to make, so how much volume you have to put up on the exchange, and also around how wide your spreads can be. And if you move too far from the last traded price or too far from the market, that will effectively count as not providing prices. The first thing I would say is I think this part of the sort of founding story of Vega is that when my co-founder Ramsey suggested that we build this, I told him that we were not going to build it because it was too hard and we couldn't. And he introduced me to a bunch of people he knew, such as Dave, who proved and showed me that it was going to be possible. So I think part of the sort of starting point of the company was we were really only going to do it if we thought we could build it. But I think Dave, as the sort of lead engineer, has probably some thoughts on that as well.
Yeah. I mean, I don't know what problems other people are having. I guess for myself, in the last 20 years or so, I've probably delivered for other people between 500 and 1,000 projects. So, I'm not really scared by the prospect of doing something pretty weird and theoretically hard to do. But yeah, we put together a really good team of quite senior people, and we were able to just say, okay, well, what's the simplest thing that could work, and you know, make some progress. Now, we haven't figured everything out yet, for sure, and we really need to figure some stuff out in a lot more detail. But I think as a basic kind of prototype, we're starting to feel quite comfortable with where things are going. There's still a lot of problems to solve, though.